Index funds can be one of the best ways to build wealth, and today we're going to cover the top 5 benefits of index fund investing. The first major benefit of index funds is that they're passive investments. For those unfamiliar, index funds are a collection of stocks, bonds, and other assets that are set up to track particular market indexes. For example, you might have a fund that tracks the S&P 500, where if the S&P 500 went up 10%, your investment would go up 10%. You aren't responsible for buying and selling individual stocks or bonds that make up these indexes, and instead the index fund passively tracks this for you. This is a major benefit because it frees up your time and energy to focus on other things. The second benefit of index funds is that they typically have phenomenal returns. Actively managed funds are constantly trying to beat the market, which basically means they're trying to generate more money than if you invested in index funds. The truth is though that most of these actively managed funds don't actually outperform the indexes in the long run. According to Business Insider, about 90% of actively managed funds did not return investors more money than index funds, which means that 9 times out of 10, index funds are the better choice. I'll link a video up here where I discuss when Warren Buffett bet $1 million with a Wall Street expert to prove this point exactly. The third benefit of index funds is that they're low cost. Remember those actively managed funds I was just talking about? Well, most of them come with high fees that pay the salaries of fund workers to research, buy, and sell individual stocks trying to beat the market. These fees eat into your profits that you actually gained from your investments. Index funds, on the other hand, typically have the lowest possible fees, since they don't need to actively pay people to research, buy, and sell stocks trying to beat the market. The result? You get more of the money you've invested and lose less to fees. This low-cost structure is a massive benefit to index funds. The fourth benefit is diversification. Most index funds are made up of a large collection of stocks or bonds. This oftentimes means the money that you've invested in the fund is actually invested in hundreds and sometimes thousands of different companies. Because of this, if a particular company's stock goes down, you won't feel the full effect of this, as your index fund has your money invested in lots of different companies, and that might be counteracted by another stock that's going up. An example of this is the S&P 500, which is made up of 500 of the largest US companies. In any given year, some of those companies' stock prices will go up and some will go down. But overall, the collective increase of those stocks have risen 8% over the last 50 years, meaning that if you were to buy an index fund that tracked the S&P 500, you would have experienced 8% growth without having to deal with the individual companies whose stocks went up and down. The fifth major benefit of index funds is their tax simplicity. Normally, whenever you sell a stock for a higher price than you bought it for, you have to pay tax on the profit you made. With index funds, you aren't actively buying and selling stocks trying to beat the market. Because of this, you have fewer taxable transactions, which means you don't have to constantly pay taxes on your gains. This means your day-to-day tax bill is less, and you have to spend less time and energy managing your investment taxes, which is a plus. Please let me know what your thoughts are on index funds in the comments below. And if you enjoyed this video, please give this video a like and subscribe to the channel to see more content in the future. Thank you all so much for watching. I really appreciate your support, and I'll see you in the next one. Bye!